Well, ladies and gents, welcome to this evening's presentation, which is really around tax planning. I think this is a really important topic because obviously for the last month, 2 months, we've been focused on JobSeeker, JobKeeper, PAYG, tax relief, all those things that are associated with the coronavirus and the COVID situation. But I think it's really important to make sure that we do keep our eye on the other game that's going on, which is around tax. The end of financial year is approaching. I know that it's important to make sure we're making good decisions now from a taxation point of view to get your affairs in order so that before 30 June you can make some decisions to make sure you end up in the best possible way. Now my job tonight is going to be facilitating the questions and the answers. So if you could please type your questions into the chat box, not the Q&A please, but into the chat box. I will be looking at those questions. I'll be asking those questions on your behalf, making sure you get the questions answered that you need answered. And then I'll let Adrian present from there. For the dentists that are on this call, this webinar will be recorded. It will be part of the COVID care pack that we have put on. We'll make this recording available to you. If you have not already accessed that, and you can get it for free by heading across to savvydentistacademy.com/SDA free. There's a bunch of training there around COVID. There's a bunch of training there around employment law. There's a bunch of training around things that we've done around aligning teams, heaps and heaps and heaps and heaps of stuff in there. And it's our gift to the dental profession to try and help them get through this coronavirus, I should say, period of time. But really the main attraction tonight is Adrian, and he's going to be talking about tax planning, about getting your house in order. So mate, over to you.
Thank you for the introduction. And like the last webinar, I think it worked really well. What we're going to do is we're going to hold off all questions till the end, and that way we'll cover all the content. So if everyone you can type your questions in if you want, and we'll handle all the questions at the end. So tonight's, before I get into tonight's webinar, I just want to mention a couple of updatey things. First things first, JobKeeper, dear, we won't go into enormous detail, but let's just say there's still a fair bit of instability around at the moment with that and a lot of uncertainty. So everyone's trying to do their best, but nothing is 100% clear with anything to do with JobKeeper. I just want to put that out there. We can only do our best with what we're told. But for example, I was chatting to Jesse late Friday afternoon about some alternative tests that they've spoken about now for about 3 weeks. I only got that information late on Friday. So this space is still changing every day, and it's very hard for us to advise accurately for people when these goalposts seem to keep moving. But just on that note, of the alternative tests, I'm going to do a little webinar on it that I'm not going to invite people onto, but I'll send everyone a copy of it, right? So in other words, I'm just going to record the update bits and I'll just email it out to everyone because everyone's busy. We've had a lot of webinars, so I just want to give people a quick update on what's changed, and then they can assess whether it affects them or not in a forum at home. So I'm going to be doing that either tomorrow or Wednesday to give you an update on that. It's not going to affect everyone, but it's still worth a quick look in case it does affect you, and it affects when you're registered from, just in case. Second point, and also on that webinar, I'm also going to do a quick update on the states. So what other stuff's available in your state. I'll do an update on that at the same time, okay? So that, again, might not affect everyone.
Adrian, may I just interrupt for 2 seconds because there is an important question that's come up out of the gate from Sonia, and I just want to address this directly. Is this webinar specific to clients of Superior Accounting Group, or is it a generic partnership value add for Savvy Dentists? It is both, Sonia. So yes, you'll have the opportunity to have one-on-one personal meetings with Adrian, I'm sure. I'm assuming that you're a client of Adrian's, but because there's a lot of dentists in the group as well, we invite those dentists in. So definitely there's something in here for everyone, is what I'm trying to say. And
also further to that, Jesse, I know who's written that, and you are a client of ours, and you will be having a one-on-one. But like the JobKeeper and all the other things we've covered in other webinars, that webinar was designed to provide general knowledge about a lot of things. And then with the one-on-one chat we had about all the stimuluses and everything that was available, we had a one-on-one chat to make sure that applied to you and your circumstances. The same applies here. It's a generic conversation about the different types of rules that exist. And then we'll be having all business clients of ours, we'll be having a one-on-one chat with to specifically design a tax planning strategy around those rules applying to you. Okay, so that's a good question, but same sort of thing. We'll be getting into more detail one-on-one, but it's still good to have some general knowledge. Next question, next thing I wanted to cover off on is it's come to my attention that once you lodge your BAS, it's the trigger for a lot of the stimuluses, right? Which I don't know if people know that or not, but it seems to trigger it as soon as you lodge. So if you haven't lodged yet, make sure you do everything in your power to lodge, because that's the trigger point for your stimuluses initially, the boosters. But the other thing that's come to light is if that booster payment leads you into a net refund position, not everyone is getting that automatically paid to them, from what I can tell. So keep an eye on that, okay? Keep an eye on when you lodge your BAS. And if you, for instance, if your booster payment outweighs anything you owe on your BAS and you're owed a net refund, keep an eye on it, because I've seen quite a few instances recently. It seems to be very haphazard, whether the ATO are actually automatically paying you the net refund or letting it sit as a credit on your account and you don't even know it's there. So please make sure you be all over that and speak to your accountant or / tax agent / bookkeeper to make sure they're all over it, okay? Because the last thing you want is the money sitting in the ATO's coffers when it should be in your bank account, right? Next thing, today's the first day that you can actually do all your monthly reporting for JobKeeper. Now, JobKeeper, and that's for those that have enrolled and applied for April, because not everyone's done it for April, right? But for those that have actually paid JobKeeper payments to staff in April and have enrolled for April, you've also got to lodge a monthly declaration stating how many employees for April, together with turnover expected for April and turnover expected for May. It is a requirement that you do that every month. And my understanding is, if you don't do that, you won't get coin. So I believe it's the trigger point to getting your money back from JobKeeper is that you do this monthly declaration, and that's available now. But what we're doing is we've dug a bit today, and it's not clear even how that's all meant to work, right? Because Xero, it's not clear. From our intensive purposes, we spoke to Xero today, and it doesn't look like they have the facility in place yet to actually do the JobKeeper monthly reporting that facilitates your payments, from the ATO reimbursements. So what they told us, which I must admit quite disappointed with, they said to basically, there's a link you go to say what you want changed in the software, and if you get enough people doing it, they'll change it. And I would have thought that would have been something they would have automatically done, because it's a trigger point for getting money back. But so the only other way of doing it is through the portal, which either your accountant or bookkeeper would have to do for you. And that's a bit more laborious than, because your date of birth and tax file numbers are automatically recorded in your single touch payroll software, which is Xero. I thought that would be an automatic thing to go straight across and you'd be able to do that reporting really easily, but it's not that easy. So what we're doing on Wednesday night at 4 p.m. is we're having a little bit of a refresher on what needs to be done for that. And anyone on this webinar is invited to that. So if you haven't received an invitation to that, and even if you can't be there, register, because you can look at it later, right? And I think it's important knowledge that you need to be aware of for your monthly reporting for JobKeeper. But if you haven't received an actual registration email today, can you email bdm@superioraccountinggroup.com. So that's bdm@superioraccountinggroup.com, and we will send you an email to that. And even if you can't attend because you're working, that's cool. You'll get an email version of it later. At least you can watch it, okay? It's really important to know the monthly documentation you have to all do. The last point I wanted to highlight, sorry about all this, but all this stuff is just reared its head in the last 2 days, right? And that's welcome to our world at the moment. Last thing is tax planning, which is, hey, what I actually was meant to be talking about tonight. given, and Jesse touched on this at the start, everyone obviously in recent times has been focusing on what we can, what help can we get from the government and what do we need to put in place to maximise all that, which is wonderful. But prior to that, they still had 9 solid months of business and income. And so at the end of the day, the tax planning side of this cannot be neglected. It's really still really, really important. 1 bad month or 1.5 bad months still could mean a tax planning issue and some tax issues. So it needs to be addressed. But what we are wanting to do ourselves is, and I'll take you right at the last slide before I take questions. I'm going to take you through a little bit of how we attack things from a tax planning point of view. I'll take you through a spreadsheet, a sample spreadsheet. And the more accurate you do the tax planning, the better you can be in making sure you do put strategies in place and you can have some control over how much tax you actually saved. It's not a hit and miss. There's a bit of structure behind it and a bit of thought, and a fair bit of discussion goes on one-on-one between us as your accountants and you guys when we have that one-on-one chat. It's really crucial. But we're going to have to, in the past, we would have normally done tax planning a month earlier because of COVID. Everything got thrown out the window. And normally we would have relied on March figures to project forward. This year, we're going to have to rely on April as well because April's been such a changed month for every business. We have to make sure we try and factor April into our calcs. So all our tax planning, not by our choice really, but thanks to the government and COVID, it's going to be late May for most of our tax planning because we've got no choice. Which is about a month later than what I normally would like to do it. But we're going to have to factor April in as well. So make sure all you guys are on top of all your figures and make sure all your figures are up to date. So now I'll get into the presentation. Sorry for, oops, hang on, went the wrong way. Okay, so what I cover, I always do this because I'd like to, because there's also a lot of investors who come on this who are also business owners. So I do business tax planning, but I also touch on investors too, because it's important because if someone sold a property, they might be able to undertake some of these strategies to help save capital gains tax. So, but once again, I wouldn't, and this is what this disclaimer is about, please to take no action from what I'm discussing today, because it's really crucial that these strategies are tailored to you because everyone is very different. Totally different, and what suits you might not suit 20 other people. So please only use today's general information, and it's really designed, and that's why I wanted to really get it out tonight, as it's the first day in May. Really, it gives everyone nearly 2 months to get their head around this and start planning for things, and I think that's really, really important. So, and this kind of summarizes how we think. Business is at the center of everything. And it's the combination of your business being the driver and self-managed super funds, shares, structures, insurance, deductions, and properties. The combination of all that creates your prosperity plan for you and your family for the long term. And I think that's a really good snapshot of how your business fits into all this. So it's the key issue, obviously. It's the key point. Okay. All my slides are obviously based around a small business. So to state the obvious, a small business is clearly you're running a business, but the turnover for you or connected businesses has to be 10 million or less. You'll note that a lot of the stimulus packages and everything else, it's got higher turnover thresholds. When it comes to small businesses and doing a lot of tax planning strategies, small business enterprises are the ones who can only benefit from these slides. It's very hard to get much out of anything if you're over $10 million. It's a lot harder to implement these strategies. And for the purposes of my slides, I'm going to be using cash basis for tax and GST purposes. And I don't want to confuse everyone with that, just so you know. Now, with prepaid expenditures, basically small businesses and individuals who aren't running a business can claim immediate deductions for prepayments. Generally speaking, otherwise, things are apportioned according to the period that you're paying them over. And I'll skip over that. It's not really that important. Okay. Now, first things first. And once again, this doesn't suit everybody. Lease payments. So consider potentially prepaying lease payments on assets such as non-luxury cars. Now, to put that in context, a luxury car is where you've bought something over 57,581 ex-GST. That's deemed a luxury car, because you don't get the benefit for prepaying leases for luxury cars. And also you'd want to be able to have a high business use on your cars if you're prepaying them as well. Computers and other office equipment, rent. Consider prepaying rent on your business premises, especially where it's owned by one of your trusts or your self-managed super funds. Insurance for small businesses or landlords, you can potentially pay your insurance premiums, bring them forward and pay them before the 30th of June. Interest. One of our biggest costs as business owners and landlords is interest. So potentially, if you've got an income producing loan or overdraft, you can potentially consider contacting your bank and prepaying up to 12 months interest in advance. One thing, and that's a really common strategy where say you might have, as an individual, you might have sold a rental property individually and incurred a capital gains tax. If you've got other rental properties outside of that property that you've sold that are in your name as well, you can potentially pay up to 12 months interest in advance for the property. And now it's got to be in an individual name, not in the trust name, to be able to do this. But some people might say, well, what benefit do I get out of that? Well, the benefit is if you sell a property and pay capital gains tax, that tax is gone forever, right? Whatever tax you end up paying on the sale of that property, it's gone. You get no benefit for it. You've made money, obviously, which is wonderful. And the whole purpose of having a property is capital growth, right? And income, but the capital growth is king. If you sell a property and trigger capital gains tax, then anything you can prepay brings it forward, helps you save capital gains tax. And it means next year, okay, you've got to bring forward the cash flow to pre-30 June, but you're not going to be paying the interest in the next 12 months. So over 12 months, you're in the same cash position, right? But you can save significant capital gains tax as a one-off benefit to potentially doing that where the property's in your own name. Next is travel expenses. So if you know, probably a little bit more of an awkward one at this time where COVID is and booking travel and everything else, but I think next year things are going to be a bit freer than what they are right now, as in next calendar year, I imagine. Obviously, I don't have a crystal ball, but I'm assuming that next year will be a lot freer. But at least I think they're going to free up interstate boundaries sooner rather than later, right? So in the next, I would imagine if things don't go awry in the next month, that they may well start to free up interstate travel for us as Australians. So, you know, if you're considering business or work trips, especially interstate, maybe not overseas, because I think you need to be pretty ballsy to book an overseas trip, I think, at the moment, because you can't get in or out of the country. But potentially consider booking and paying the Air Force by 30th of June. And same with any seminars and conferences. If you're know you're going to be attending some seminars and conferences, once again, that might be a little bit awkward in this current environment, but it depends how far out you're booking. Remember, you can go up to 12 months out with this and pay for things in advance and claim them. Subscriptions. So if you subscribe to bits and pieces that help you run your business and are a part of your knowledge base to continue running your business, why not consider bringing forward the subscription and paying for it before 30th of June? Rates for small businesses and landlords, potentially paying council rates in advance. Body corporate fees, same deal. Consider paying body corporate fees in advance before the 30th of June. Now, if you're a landlord, an individual landlord, you can buy assets up to under $300 that can be written off in full. So for instance, you know, if you need some more light fittings, ceiling fans, curtains, blinds, etc., under $300, you can potentially buy them and write them off in full. The only exception as a landlord, they can't be a like asset. So you can't go and buy 5 ceiling fans at $200 each, or you can't buy something that's part of a set. So in other words, they don't function independently. They function together. That 300 threshold has to be that. I'm not going to, the old rules, which is going back a few years, this is where I'm going to slow down a fraction. It used to be that you could only write assets under $1,000, which is going back a few years. What I really want to focus on is this slide. I'm going to stop and pause and put a bit of time into this slide. I've gone through the other stuff quickly because people can watch it later. All right, this landscape has been very dynamic in the last 12 months. So I'm going to take you through each item very carefully. And this is a really, really crucial part of tax planning for me this year, because there's a lot of people who can see that they're going to have a big future with their business, right? And they've just got a hard period they've got to work through right now. So if they're considering renovating, buying equipment, et cetera, that's going to help their business moving forward, then this could be potentially a wonderful strategy, especially with what the government have done, which I'm sure everyone's aware of, that I'll go through. So with assets, including software, now this is per asset too, okay? From 1 July 19 to 11 March 20, which is just before the government bought out the COVID stuff, you could claim an immediate deduction for any assets that were bought that were under 30 grand, excluding GST. But from the 12th of March to the 30th of June, they raised that to 150 grand. So what that means is from the 12th of March to the 30th of June, if you bought an asset that's less than 150 grand ex GST, you can potentially write it off. Now that's per asset. Now, there's a couple of disclaimers with that, and I'll come to them in a minute. The dates are important because that's when the asset has to be first used in the business or installed and ready for use. So basically it means you've got to have it and you've got to start using it, or it's got to be basically ready to go all before the 30th of June. That's crucial. Now, the other two elements with this is these thresholds excluded in it are capital works and structural improvements. So things like, I'll give some examples, things like all the hardcore stuff about renovations. So your plumbing, your electrical, your slabs, your frames, your roofs, your plaster, your timber cupboards, all the hard wearing stuff that lasts a long, long time, that is all excluded from this, okay? And the other thing is cars. I mentioned it before. Cars have a maximum depreciation cost limit of 57,581 ex GST. So if you want to buy a car and try and claim it fully, you can't buy it for more than 57,581 ex GST. Now the only other thing with cars, and this is beyond the scope of this webinar today, but with cars, it's governed by the business use of your car. So with a car, you don't just get to claim 100%. There are some exceptions. So if you buy, utes and other things that are designed to carry more than a ton, generally speaking, they're exempt from logbooks, right? But if you buy what I would call a normal passenger car, right, and you want to claim it, your ability to claim the tax deduction and GST and running costs is governed by your logbook. Now, I've had webinars and sessions on logbooks before. I won't go into that now, but logbooks are really, really crucial. Now, like everything, if you guys have been on my webinars before, you know that we're pretty practical people. So there's ways to do logbooks to get the most out of them. You've got to dot your I's and cross your T's with your logbooks. And it's important that you've got your head around that before you go and buy your car. Don't get all excited about buying a car. Make sure you think about how much business you use, what can I do? And there is, practical things you can do to maximize your business usage in your logbook, which I'm not going to cover today, but it's really important that you factor that in before you buy it. And look, in my personal experience plus experience through clients, the two best times to buy cars are end of financial year and end of calendar year, because calendar year, they have a plate run out clearance when they're getting rid of their old years and going into the new plate clearance. So that's a good time to buy. Plus end of financial year is normally a very good time to buy. Not that I'm encouraging you now to go out and buy cars because they're tax deductible and all that sort of stuff. There might be a hidden benefit to that, but, and you guys as business owners are entitled to treat yourselves now and then too, and go and do these sorts of things, because they are, not everything's about tax and deductions. There's some enjoyment of doing things is important as well, right? So, but excluded from these thresholds are capital works and structural improvements and cars. So importantly, and this is why I want to pause on this slide, this might be one element in your business you give a lot of thought to, okay? Because if you know, for instance, that you're going to be doing asset purchases that your business needs and other bits and pieces in the next 12 months. I'm telling you now, 150 grand ex-GST is one hell of an incentive to consider potentially doing it before the 30th of June. But remember, I draw your attention to this. It's got to be first used or installed ready for use. So you can't go and buy a car on the 29th of June if it's not going to be there for another 2 weeks and you can't drive it. It's not going to count, right? So plan this, which is why we're having this now. And further to that point, you can finance these things and still claim them as tax deductions. So for instance, if you want to go and buy a car that's under 57,581 and you can claim a large percentage of it business use, or you want to go and buy some equipment that your business needs, that you know it needs, 150 grand is one hell of an incentive to claim things as a tax deduction. But this is where the one-on-one strategy comes in. We've got to talk this through, right? Because it's not one shoe fits all, but you don't have to pay cash to get these as tax deductions. You can actually borrow from the bank and buy these things and claim them as tax deductions and pay them off. So you can potentially get an outright deduction for something that you've paid not a cent for and you're going to pay off. I'm not saying that's the right or wrong thing to do, but I guess what I'm saying is think about this. This hit area is massive, and 30 grand to 150 grand, that's 5 times the deduction, right? So crucial decisions, and don't rush them, but plan, but make sure if you're going to buy something with finance, you allow time to do your shopping, do your negotiating and get your finance in place, or to take ownership before the 30th of June, because it's got to be first used or installed ready for use. Now, the last point I wanted to highlight and bring your attention to too, I reckon as a percentage, for every new client that comes and works for us, works with us, sorry, not work for us, with us, I would say this area is done wrong 95% of the time by other accountants. They don't understand how to maximize the rules in depreciating assets and writing them off and claiming them. And out of our amendments that we make for other accountants doing things wrong, that would be 95% of them would be in this space. And the other important thing here is when it comes time to buying these assets, it can be as simple as what wording goes on there, or how things are written, what descriptions are on there, how the invoice is broken up. You know, there's lots of things that go into maximizing what you get out of these rules when it comes to writing assets off. So I'm harping on this because this is a big ticket item in my experience where it gets done wrong by other accountants, and wrong most of the time. And secondly, for you guys, I think you've got a wonderful windfall opportunity here. If you're factoring it in, that you can potentially get a massive tax deduction that you wouldn't normally get. So I think we really need to pay a lot of attention to this and do a lot of planning. And when we're planning with clients we work with, we spend time on working through what they're looking at buying, and also working through on how they're written, what invoices, what stuff's on the invoice, asking questions about what they're actually buying. And, you know, when you drill in a bit deeper, there's potentially more gold there in terms of claiming what you can claim. Okay. And it's really, really important. And for landlords, if you buy an asset for under $1,000, you can write it off. And if it's over $1,000, sorry, not write it off, wrong. It goes in a pool and you get 18.75% of it depreciated in the first year and 37.5% of it in the second year. Other things you can do to save tax is consider paying bills in advance before the 30th of June. If you've got loans that, and this might be the case in this current environment, if you've got loans as a business owner or a landlord that because you locked in way, you know, when the rates have been dropping so much in the last 12 months or so, you could, pardon me, potentially refinance away from the higher interest and to a lower interest loan, incur the penalty interest and claim it before the 30th of June. Now, I'm not saying rush out and do that. You've got to do the numbers, right? You've got to do the numbers and say, how much am I paying to get out and what am I saving and how long am I locking that saving in for? But there has been plenty of times it's worth it, but you've got to plan for this because the banks take time. When I talked about prepaying interest with the banks before, if you went and spoke to the bank now about prepaying interest, it takes weeks to get that put together. Okay, so you've just got to be mindful of that. And same with this, if you want to refinance, at the moment, the banks are swamped with all the stimuluses and 250K unsecured loans and people wanting to defer their interest and all that sort of stuff. Just get onto it now if you're going to do any prepaying or refinancing. Consumables, if you need stationery, etc. Now, technically, they're meant to be consumed within 3 months, but I don't know how easy that would be to work, but trace that back. Client gifts and business owners or landlords. It's common practice to offer gifts to your clients and suppliers, e.g. wine, gift vouchers, etc. So once again, consider buying such gifts and paying for them before the 30th of June. Super. For anyone who's an employee of their own business, they should be paying themselves 9.5% of their gross wages anyway. And if you're not, you can still pay a super contribution, or you can top up your employee contribution as a business owner to max out at 25 per person. But the important bit is super contributions are only deductible to the extent that they are actually paid to the fund before the 30th of June. So don't pay it on the 30th of June. Make sure that your super fund receives the money by the 30th of June. I would never leave it to the last day. It's too risky. And there's a possibility, and it may or may not be viable this year, but it's something worth consider, where you can potentially claim 2 years worth of super contributions in 1 year. Now, obviously, your super fund deed has to allow it. You can only make the contribution in June, and the reason you can get a double dip in effect is that super contributions do not need to be allocated until 28 days after the end of the month. So it means if you make a contribution in June, that it's not going to be allocated to July. Now, what that does mean, though, and where you need to plan for this, that means you can't make any further contributions next year until June the following year. But it depends. The only time I'd consider something like this is if for some reason you need the tax deduction now more than next year. So if your tax rate this year is going to be much higher than next year, this strategy is something that might be worth looking at. But you've got to plan again. If you're not getting anything out of this is all about planning, which is why it's called tax planning. It's not just to save tax, it's also to maximize what your business gets out of everything, and also maximizes your cash flows for what you get out of the cash. Deferring capital gains tax. I touched on this before a little bit. If you sell a property or a business, you can potentially consider deferring the capital gains tax. Now, that can only be done with a put call option agreement. So you guys might all know this, but I'm still going to go over it. CGT, or capital gains tax, is triggered by contract date, not settlement date. So if you sell something in the next 2 months and you sign the contract before the 30th of June, irrespective of if you settle in July, August or September, the tax is payable this financial year because the capital gain is triggered by the contract date. Now, the put call options come very handy at this time of the year, because if you wanted to put something on the market, what you can potentially do is get your lawyer to draw up a put call option agreement. Now, what that does is it commits you, the seller, and them as the buyer to actually go ahead with it. It's legally binding. But what it does do is it defers the signing of the contract till the start of July. Now, it doesn't sound much, but hey, for a few bucks with your lawyer to draw this up, and any decent lawyer, this should be bread and butter for them. For a few bucks, the money's in your pocket for another 12 months. Now, I don't know about you, but I'd rather have the money in my pocket, and the opportunity cost means I can use that money to do lots of other things. But if you do this strategy, please don't blow your money. Please know that you're still going to have to pay the tax, but you've got 12 months extra in your pocket. But plan for that payment in 12 months. Don't come to the ATO in 12 months' time saying, I've got no money left. I've spent all my money that I've allocated for the tax. You won't get a hell of a lot of sympathy. So please make sure you plan for this, and certainly worth it, especially for sales at this time of the year. It's worth doing this put call strategy to save some tax and defer it for 12 months, because to me, that's better in your pocket than the tax office pocket without any issue whatsoever. Now, What I'm not going to take questions just yet. What I'm going to do is I'm just going to go into my example that I spoke to you guys about. Just give me 2 seconds. Share screen. Sorry, just bear with me. Okay. What I want to take you through now is just a rough sample of what we do for our business clients roughly, right? Now, don't get caught up on too much in here. What it's designed to show you is that we put a bit of work into and analysing what information transpired 12 months ago. And so in this example, Blogs Group Tax Planning, ABC Proprietary Limited, which is a trading entity, we put the 18 figures in for income and expenses and what tax they paid. Now, I've used 6 months now, but it'll be 9 months or 10 months would go into the middle column. And you put in the actual income out of zero and expenses out of zero, and we project forward to work out what the annualized income and expenses are. Now, remember, this is all pre-strategies. So all we're doing at the moment is trying to get a snapshot of what happened last year here. In other words, what happened with the income and expenses, what tax was paid here, actual figures out of zero or whatever software you use for whether it be 6 months, 9 months, 10 months. And then we project forward here to work out approximate income and approximate tax payable positions pre-tax planning. And then here's another example of a business trust. We do the same thing. We put in the actual income and expenses here and who they were distributed to, Mr. Blogs and his bucket company. And we put in the actual income and expenses here to give a profit for 6, 9 or 10 months. And then over here, we project forward for 12 months, including depreciation, to see what the net profit position is and what approximate distributions are going to go to Mr. Blogs and bucket company. And then we get down to bucket company, roughly what distribution was received and how much tax was paid on those distributions last year, rough expenses for the 6, 9 or 10 months, projected forward to income and expenses and approximate tax positions. And then with Mr. Blogs, he had a rental property personally. So there's the rental property bits and pieces. Projecting forward, obviously that's not in zero. We're projecting forward to what would be approximate rental property position with the wage he drew last year and the way distribution last year, and same here, and approximate tax payable positions, or that's actual tax payable positions from last year, and approximate tax positions this year. Then what we do is, like I went through things before, I quickly go through all these things with everyone. So the strategies I mentioned in the tax planning slides, I quickly go through with each person, yes, no, yes, no, yes, no, and whether it's applicable to them. And if it's yes, I haven't put it in here, but what we normally put is what sort of dollars they're looking at. Same with seminars, assets. Obviously, we spend a bit of time here because, especially this year, a lot of time has to be put into this because there's such a windfall opportunity here that I don't see ever happening again. And then all these other things have been mentioned, you know, client gifts, super contributions, capital gains, all that sort of stuff. And if it's yes, we put some details in here. And if it's yes, it'll flow back, we'll flow it back into here and change all these figures. So that way what we do is with all these, with all these figures in this column, they know the position before we start tax planning. And then what we do is we make the adjustments from our tax planning discussion, and they then know the position after tax planning has been made and what benefit they've got out of it and what tax they've saved and roughly what their position is going to be in 12 months' time, which this is done for every client we have a tax planning call with. So there's a fair bit of effort goes into this, but the effort reward's there because you can then see a snapshot of last year, this year to date, and then estimate it. And then after the tax planning, I think it's a wonderful summary for people to implement from and get an idea of what they're going with. So let me stop that share. Hang on a second. Share screen. Hang on a second. No, not that one. So just bear with me. Sorry, guys. Where is it? Share screen. We want.
I'm glad you're a good accountant.
Yeah, no. Sorry, I can't drive this for crap. So please forgive me for that. Is that it there? No,
Just flick through it. Can you flick through for
doesn't
me?
matter. I'll just go to.
Like,
Yeah. So, any questions? Now we can take questions. I've gone through real quick because it's night time and people are tired, so people can rewatch this and listen to what I've said and all that sort of stuff, right? So now we've got question time. So let's fire away.
all right, mate. Couple of things. There's quite a few questions in here. All right. So, something about logistics, mate. Wednesday's webinar is saying 4 p.m., but when you register, it's saying 5:30 p.m. So, you might just need to clarify the time on that webinar for Wednesday.
Yeah, it is 4. I've just got
It's 4. It is 4 o'clock. It's actually 4 o'clock, guys. It was originally set up wrong, so it's actually 4 o'clock.
Okay, cool. All right, just a little detail. If I sell my dental practice, can I defer capital gains tax for up to 2 years? Would I be entitled for a double discount of CGT if I were running it for 5 years prior to the sale?
Hang on, I'm lost with that. I'm just going to try and see if I can see these questions as you're talking to me too, mate.
Okay.
Yep. The volume at my end's not very high.
Can you hear me okay?
Yeah, yep. I'm just going to see if I can see the chat. Okay, I can see the chat box now.
So I'm looking at a question from Mo.
Which question are we talking about?
Mo, if I sell my dental practice, can I defer capital gains tax for up to 2 years? And would I be entitled for a double discount of CGT if I were running it for the 5 years prior to sale?
Okay. If you sell a dental practice, this is probably past the scope of this call here, to be honest with you, but in a nutshell, you're on the right track because it's getting a bit too personal for this, but under the small business capital gains concessions, you can actually potentially, depending on your age and how long you've been running the business for and the whole host of other things, there is potential to defer capital gains tax for a period of time. It gives you the ability to buy a replacement asset. And if you don't buy a replacement asset within that time, then you have the capital gain triggered then. But I think that's probably something that we need to talk about a bit more one-on-one, mate. I think it's getting a bit too one-on-one for this. But yes, you're correct. There is scope to defer capital gains tax and for a period of time. But if you don't buy a replacement asset, subject to so many other things, so that's why it's hard to generalise, then it's triggered at a later date.
All right. And Jacob asks, when prepaying rent, how far in advance can we prepay it? I thought you said 12 months.
12 months.
12 months, yep.
But you want to, if you're going to do 12 months, prepay in June, right? So, because if you prepay in May, you're only prepaying 12 months from May, right? So if you're going to prepay anything, prepay in June.
Yep. Okay. So going back.
Hang on. Sorry, mate. But understand something. It depends who you're paying it to, right? If you're paying it to yourself, you'll get a tax deduction for your business, but it's income over here, right? So if you're paying it to a landlord, they might, as much silly as this sounds, that might not want the income in advance, right? So you've got to negotiate all this stuff, and it depends on who you're paying it to and all that sort of stuff. But yes, potentially if you prepay something, I'll be paying it in June.
All right, cool. Just going back a bit earlier, there's a question from James about does JobKeeper cover the start from the start of March or from the 30th of March?
Well, how it works is, and I encourage you to go back and listen to our JobKeeper webinars that I'm sure you've got access to. Basically, you've got to be employing someone on the 1st of March. But what you're talking about, I think, is that the JobKeeper fortnights run from the 30th of March that the ATO are reimbursing for. So I think that's what you're talking about. The actual fortnights that you get reimbursed for in arrears start from the 30th of March.
Cool. All right. And we've got a question here. When will tax planning 101 start? If we need to buy a new work vehicle, we'll need to do it by about 10th.
Is this for us, like our clients? Is that what you're saying?
Yeah, this is one of your clients because this is definitely not a dentist. I'm not sure if I can name them by name.
No, that's fine. It's all right. we're, and I'm sure you can appreciate, whoever this is, I'm sure you can appreciate, we're taking a breath after 6 weeks of hell, but we're in the process of putting together sessions of when we're going to do it. We're looking at having our sessions starting no earlier than the last week of May, because we've still got to do some prep work for all these sessions. As you saw before, it's not just let's have a session. It's not that simple. And we haven't even been able to even think about it until about now. So last week of May, first week or two of June is unfortunately when we're going to be doing them all. But that's the whole point of having this, so people can start thinking about what they want to do and have stuff in place so they can pull the trigger on it, if you know what I mean.
Having said that, when they get the call to organise to schedule the call, if they've got something pressing, let Grace know,
Yes.
And we can work around it.
Yes, if something's super urgent, like you're trying to finance some equipment or whatever, like we've spoken about before, and it's time sensitive, well, we can factor that in, right? But yeah, I don't think we'll be having any calls until the last week of May. That'll be the first calls booked.
Okay, all right. Now, just while getting a message here, I was asked to tell you that was from Shan.
Okay, no worries.
Cool. Neil asks, if May is looking like your income is going to increase by about 20% from April, yeehaw, will this cause JobKeeper to stop for May?
No.
So
Do they qualify for?
if you've qualified for
April.
So I think I understand that question. If you qualify for JobKeeper in April, right? So in other words, I won't go into all the details, but let's say you've dropped 30% under whatever test is appropriate for you. Because remember, I haven't covered the alternative test. That's coming in the next couple of days. But assuming you've passed the ATO JobKeeper testing of 30% minimum drop in April, if your business subsequently recovers in May, June, July, August, and September, you're still eligible for JobKeeper for the whole period. You've only got to pass the test once, and you're eligible to get JobKeeper for the rest of the time. I think that's what they're asking.
Yeah, I believe so. Perhaps Neil can just confirm that answers his question. I believe so. Yeah, got it. That's cool. Cool. Adrian, with self-managed, I've got a question for you. Self-managed super funds, beyond making early contributions and so on and so forth, any special little nifty tricks we can do there? Beyond contributing prepaying our year's worth of super.
Yep.
Any other little rabbits out of the hat that we can pull?
Not with super.
No, bugger.
Super's one of those things that the government's tinkered with nearly every 12 months for the last 10 years. And all the good stuff is gone, and there's virtually no freedom or flexibility in super anymore, unfortunately, aside from this paying an extra, getting potentially an extra year's deductions. But that doesn't suit many people, right? So,
now, Adrian,
not really.
Can I just double check something? On your slide about super, the contribution from up to 50 years of age was 25 grand, but I think your slide said 50 to 74 is also 25 grand. Can I just confirm?
Still, it's 25 grand for everyone.
Okay, all right.
That's the maximum age-based deduction.
Yeah, no, I've got a birthday coming up next year. I was hoping it might bring some added benefits.
That's not you talking, is it, mate?
Yeah.
You're not that old. I know you're not that old.
Anyway, alrighty. Ladies and gents, if you've got some questions, please type them into the chat box. I'll be happy to answer them for you. I can see there's quite a few people here. I can see Cal's here. I can see Ollie's here. Belinda, Ren.
Someone said that MyOb was actually able to do the JobKeeper update.
Did that?
Is that actually fact? I'd love to know more about that, because Xero were really just go to our...
No, that's Gary who said that. But I don't know, Gary, if you can confirm this or not. Are you talking about the pays being sent to the staff and them knowing that it's JobKeeper, or the end of month reporting that's required? I don't know if you can type that in and confirm that, mate, because I know Xero's set up to do all the ongoing ones, but it's the end of month reporting that's required. Can you confirm whether MyOb is suitable for that, or are you talking about the ongoing?
I'd love to put a bit of pressure on Xero if that's the case. Because they're pushing that all back on us.
Yeah.
And the business owners. You know, whoever's looking after payroll / bookkeeping, they're basically going, this is going to be your task, and not happy, Jan. So I'd love to know if that's the case, that we can go back and tell them my overdoing it. So
I don't know if Gary's gone or not. You there, Gary?
Gary's here. He's probably typing his heart out. Probably trying to keep up. There's another question here. Can you get double concession superannuation contributions to max 50K this year? I think that's what we spoke about. If last year's contributions are very little, I think if last year's done, it's done, isn't it? Mate?
Well, but yeah, you can't do anything about last year. You can only do anything about 2020.
Yeah.
With that, with what I was saying is obviously with that 50 grand, it depends on what you've made during the year already, because obviously you've got to take that off, right? So if you haven't made any contributions for this whole tax year already, for instance, you can potentially make 25 grand and then make another 25 grand in June. But remember, there's a lot of box ticking that needs to go on to see if that's viable, because as I showed you on my slide before, it really, there's lots of things you need to tick off. Now that only really suits A, where you can tick all the boxes, and B, that your tax rate this year is going to be substantially higher than next year. So it's potentially doable, but you've got to really seek some seriously good advice to make sure that it's worth it in your position and you're achieving out of it what you're expecting for forking out the money.
Okay. Mate, I've got another quick question for you. Just while waiting to hopefully hear back from Gary about MYOB. Kids and distributing money to kids.
Yep.
How much work do they reasonably need to be doing in order to derive an income from the business?
Are you talking about, okay, let me just dig a bit deeper on this. Are you talking about minors, or are you talking about kids under 18, or are you talking about?
Yeah, kids under 18. So yeah, I'm just wondering.
You're talking about distributions now, aren't you?
Yeah.
$416 is the sum total you can give them as a discretionary trust.
Yeah.
Fishery.
But where's the tax-free threshold for an under 18?
Well, no, that's after you go beyond that. There's two elements to this, mate. If they're generating, if you're distributing a trust distribution to a minor, right? The maximum you can give them is $416, because the income that it is, they tax at top marginal rate above $416. Part B to this question is,
can you pay them? Which
might sound a bit strange, but I think is where you're going with this. If you are a minor, but old enough to work, like, I don't know what, in each state, I think it's different, but 15 years and 9 months or 14 years and 9 months, whatever. I don't know the exact date, right? But let's just call it 16. If they're working for you as an employee, as opposed to getting a distribution for doing nothing, right? They can earn up to $18,200 tax-free.
Yep.
But you want to make sure that if you're paying them as an employee, there's a few things you want to look at. You want to look at what type of work you're getting them to do and what sort of rate you're paying them, and is that an arm's length rate for someone? If you're employing my kid, right, what rate you're required to pay them is the same rate you should be paying your kids. You know what I mean? Not double the rate, not treble the rate. It has to be an arm's length deal in terms of you're paying them relatively for what they're doing for kids the same age, right? And then therefore, and you have to pay super obviously on the of 9.5% on whatever wage they draw. But depending on the hours they can work for you during the year, like in school holidays, nights, weekends, etc., they can potentially earn as an employee up to $18,000 and a little bit more than that. Actually, it's tax free to $18,200, but once you get above $18,200, there's rebates and other bits and pieces. But look, simple, they can earn up to $18,200 as employees and pay no tax on that money. Now, obviously, if you give them a trust distribution, you'll have to take that off that, right? So
sure.
18,200 less 416 is what they could potentially earn. But it would have to stack up on the arm's length tests, so that the hours are justifiable, the rate's justifiable, and relatively, it all stacks up. What I call this, it smells and sniffs good, and feels good, and ticks the boxes. Then potentially your kids can work for you, and it's a very tax effective way for them to work. I think that's what you were going down the path.
Yep, I'll talk to you about that another time.
That's a really important thing. I say to everyone I speak to, a lot of this, everything we're doing today is about, there's no rocket ship that creates the world for you, right? I mean, I do think this year there's an exception with assets, because 150 grand, Jesse, you've been well in your business for a while, mate. Have you ever seen anything that good in terms of potentially being able to write off something up to 150 grand with a few exceptions? That's staggering, right? So this year, a lot of planning has to go on, because there's potentially a massive opportunity that's not going to be around again. That doesn't mean, am I encouraging you to go and buy all this stuff if you can't afford it? No. Am I encouraging you to go borrow to buy it? No. But how is it worth considering and really going down the path of? Absolutely. Because this is a once in a lifetime opportunity here to buy something that will help your business out and be very tax effective to do so. But aside from that, a lot of this, and I've used this a lot, it's lots of little things make a big difference. So that applies to everything we do. All our advice is all about do this, do that, do this, do that, do this, do that, do this, do that, advise on this, advise on that. And the whole culmination of it makes a massive difference across the 12 months.
Yeah.
And that's important. That's another element to this that you brought up. It's all about having the right advisors, the right proactive thinking and practical thinking, and working your way through things to make them stack up from an audit point of view, a tax effective point of view, and a practical point of view. And if you do a lot of those right and get a lot of advice and put it all together, it makes a hell of a difference.
Perfect. Thank you, mate.
No worries. Any other questions?
No, I think that's it in the chat box there, mate.
Right.
If anyone's got any other questions, going once, going twice, please feel free to type them in really quickly, and we'll do our best to answer them. But otherwise, Adrian, thank you, mate. You're a gem.
So I'll give everyone about a minute and or 30 seconds if there's no other questions.
I've tried to get Gary, I can't. So
Okay.
Yeah, Gary hasn't typed in, I don't think.
No, I can't get the MyHub answer, unfortunately.
Okay. I will say one thing. Thanks, guys. I know you've all been webinared out the last sort of 4 weeks.
We've been webinared out.
We've been webinared out. Jesse's been webinared out. We've all webinared out. But I really thought it was important to have this webinar tonight, being almost, okay, it's the second business day in May, but don't count Friday. It's important, and you know now why, after being on this webinar, why it's important to plan for this, because you've got an opportunity that's certainly worth looking at on all different levels. Think about it and plan for it, and it's important to give yourselves as much time as possible to plan. And for all my clients out there, it's important to do all that before we have our one-on-one, because you've at least thought about it all from your side, and then I help you apply that to get the most out of it, which makes it practical from an overall strategy point of view. So if no one else has got any questions, and it doesn't look like they do, Jesse, thanks for hosting with us, mate. I appreciate it.
It's my pleasure. Just to wrap up, mate, thank you for all the work you've done over the last few weeks, mate. I know you've been working really, really hard, as has Anita and the rest of the team there, mate. So thank you for really rolling the sleeves up and taking the bull by the horns and getting it done. Really grateful to you for all of that.
Thank you. We appreciate that too, because a lot of work's gone in, a lot of work behind the scenes that no one even knows about, and probably double or treble what you think. So we do it for you guys, and we're grateful too. So for all your messages of kind words, there've been a lot of them in the last 2 or 3 weeks, and it means a lot to us and all our team. So we appreciate that too.
Yeah. Mate, thank you once again. Anita, thank you as well. And I'll hand it back to you, mate. No
worries. And thanks to everyone giving up your valuable time. And as I said, keep an eye out over the next couple of days. It'll either be tomorrow or the next day. I'll do a quick update on JobKeeper alternate tests and some state-based things.
And if you use Xero, hopefully we can get some answers from them. But if not, feel free to join the session, the class that we're going to be doing on Wednesday at 4 o'clock.
Cool. And until then, take care and thanks for all your time.
And for the dentist, just really quickly, for the dentist, this recording will be available as part of the COVID pack as well. So if you want a recording with the others, head across to the link that I mentioned earlier, savvynessacademy.com/SDA free. You can watch it and all Adrian's other webinars up there as well. And I think that'd be a good resource for you. Cheers.
Beautiful.
Jesse, they're welcome to join that class. We're about supporting each other. So if they want that's not a problem either.
Cool. Thanks, Anita. Cheers. Lovely.
All right. Thanks,
Alrighty,
heaps.
bye now.
Good night to all.